Welcome to Show Me the Money with Michael Dirk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business in all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. Welcome to another episode of Show Me the Money with Michael Dirk. Thank you for joining us today. Our guest is our first CPA ever on the show, a gentleman named Blake Christian. Blake brings over 40 years of experience in tax consulting and compliance, serving multinational corporations, publicly traded companies, and closely held businesses. He has built deep expertise in federal, state, and local tax incentive programs and leads the firm's consulting efforts for qualified opportunity zones, otherwise known as OZ. Under his leadership, the HCVT OZ Team has formed over 200 qualified opportunity funds, QOFs is what they're referred to as, and more than 250 qualified opportunity zone businesses, QOZBs, advised hundreds of investors and professionals on formation, operation, testing, and restructuring. A recognized leader, Blake has been featured in national publications such as U.S. News and World Report, authored multiple articles and tax alerts, and developed unique OZ strategies for real estate developers, investors, and business startups. Beyond OZ, his practice includes partnership and individual tax planning with industry experience spanning manufacturing, distribution, services, restaurants, shipping, energy, and healthcare. Blake opened HCVT's Long Beach office over 25 years ago and launched the firm's Park City, Utah office in 2014. He has served in numerous community leadership roles, including vice chair of the Long Beach Community Foundation, president of the Long Beach Rotary, and chairperson of the Long Beach Area Chamber of Commerce. His work has earned recognition as one of the top 10 California accounting professionals, the Long Beach Chamber's Community Spirit Award, and multiple national honors as a top 25 Opportunity Zone influencer and tax specialist. A frequent industry contributor, Blake has written for AICPA and the Long Beach Business Journal, and also been named a top 50 U.S. tax blogger and lectured at USC, go Trojans, Cal State Long Beach, go Beach, BYU, I don't know that one, and the University of Utah. He began his career at KPMG, where he was admitted to the partnership and holds a master's in taxation from USC and a bachelor's in accounting with a minor in finance from Cal State Long Beach. Blake, that's one hell of a resume. Welcome to the show.
I'm worn out from listening to that.
There's enough acronyms in there to choke a horse, so I'm glad I got through those.
Thank you for the kind words.
Thank you for being here. I know the guests and the listeners are really going to enjoy this because obviously everyone has tax-related, I wouldn't say problems, but entities and items that they need to address on a daily basis. So again, it's excellent to have you here, especially with all your expertise and taking time out of your day to do this. So, jumping right into it, Blake, your work has spanned industries from real estate to healthcare to manufacturing. What lessons have you learned about how different sectors approach tax planning? If you can maybe touch on that.
Yeah, so obviously I've spent the bulk of my career in public accounting, which I actually left in the middle of my career as a manager at KPMG and went into private industry and was tax director of a Fortune 500 healthcare company for 3 years. And to compare and contrast, and what drew me back to public accounting is the diversity of work. On any given day, I'm working on 20 different clients, and it's daunting at times, but it's makes it more interesting. When I was in private industry, you're working on the same group of entities. Now we had 100 entities, so it didn't get too boring.
Right.
But you're kind of doing it's a little more rote, and gets a little boring after you've done it for a couple of years.
Right.
So I really like the public accounting just because of the diversity of clients, the client interaction, and and CPAs get a bad rap for it's boring, and it is. I can assure you, it's anything but boring.
Right.
There's never a day I go home and say, "Wow, that was nothing happened today." It's always a different day.
Right. And obviously, Blake, given the experience you have and given the knowledge and the different entities you've worked on, from state, federal to public to private, all these businesses you've worked on, you're obviously being very creative on these and thinking outside the box versus maybe just an in the box thinker that I would say, I don't want to say most CPAs, but I would say a lot of CPAs fall into, and they just start checking boxes and moving a paper from one side of the desk to the other. But for tax strategy, especially dealing with a high net worth individual, and I know that you deal with, for instance, people that sell large companies and all of a sudden have a very big pile of cash on their lap that,
Right.
it's in business, obviously, as you know, it's not about how much you make, it's how much you keep. And
Yeah.
so for you to have that, you know, wherewithal to be able to do that and obviously, leading right into the opportunity zones to be on that forefront, I think that's really powerful. And I know a lot of our listeners have taken advantage of these opportunity zones. So maybe because we have all different facets of listeners here, people who are been in real estate for 50 years, and some people have been in it for 20 years, and some people have been in it for 2 years. So maybe if you can just touch a little bit on maybe what an opportunity zone is and what type of client would be optimal to take advantage of an opportunity zone.
Great. Thank you for the intro on that. So the Opportunity Zone program uh, was really incubated during the Obama administration, but was completed under the Trump administration. And President Trump, in his Trumpian style, took 100% credit for devising the program, but it was a very bipartisan program and still tends to be. And it was put together by a combination of government employees, congressmen, senators, and billionaires. And the idea was, you have all these billionaires with huge concentrations of publicly traded stock, or they've got a huge real estate portfolio, or some other family business that maybe they've developed, and suddenly, in the past, their tax advisors, including us, would say, "Hey, hold on to it till you die, and then you'll get a step up in basis, and then your kids can sell the business, and you won't pay tax on it." So they said, "Well, Congress was like, how do we encourage people to trip the gain while they're still alive?" And so they came up with this program where, hey, get out of that high concentrated net worth and diversify your assets. But the trick, or the catch, is you have to invest in low income communities, which is again a noble cause. So they developed 8,700 census tracts throughout the country that you could invest in. And what the program allows you to do is roll a capital gain, can be short term or long term, into an Oz fund. And it can be what we call a captive Oz fund, where you control the whole thing, or you could invest in somebody's what we'd call a public Oz fund. And if you roll that gain, generally within 180 days, it it defers the gain. Under Oz 1.0, which we're under right now, it only defers the gain now till 12/31/26. At one point, it deferred it for 8 years. Oz 2.0 will refresh that to a 5-year deferral. So you roll, let's say it's $1 million gain into your own Oz fund. you start the deferred gain process. Now, if you hold that Oz fund for 10 years and actually invest in some of these communities and do either a real estate deal, or you can have an operating business in an Oz location, you fast forward 10 years and sell it, 100% of that gain. You could have rolled that for $1 million, started a tech company. You could start Google too, and it could be worth $1 billion. There's no cap. You could exclude, $1 billion gain, under this structure. And in real estate, what's really powerful is you don't recapture any depreciation after 10 years. So that usually gives you about 2.5 to 3% additional IRR, even if the project never appreciated, just because you're taking ordinary deductions over this 10-year period and never recapturing them.
Right.
So anyway, and then under Oz 2.0, which will come in 2027, you also get a 10% basis bump. So that $1 million gain that you deferred, you only pick up 900,000 after 5 years if you hold the Oz fund, for that 5-year deferral period.
That's terrific. And do you get if the property is cash flowing and whatever it is, or the fund or whatnot during that period, do you get to take the revenue, or does it have to be reinvested back into the fund?
No, you can, during the operating period, you can make distributions and things up to your basis.
Okay.
And you do have to keep in mind you start off with zero basis because you haven't reported the gain yet. And so, but if you have debt in there, in the partnership context, you get basis for that. So you can make distributions without taxability. And then most people, after a 2-year period, you can do a cash out refi with no tax consequences.
That's huge.
Yeah.
That's again, we do that a lot for clients on the cash out refinances. And to do that, I don't know where else, Blake, to get tax-free money like that with real estate is such a great asset class. You get the appreciation, you get the cash flow, and then you get to take your money out tax-free and do it all over again. It's such a beautiful vehicle to be able to take advantage of.
And this program is so flexible. Again, virtually any capital gain that you have, and it can be short term or long term. You could sell Bitcoin, you could sell a family business, you could sell a stock portfolio, pretty much anything. We've seen it all, and you can just roll it in there and start the deferral period. And during that 10-year operating period, all the tax losses from depreciation and things are flowing out to you. So you're getting that advantage while your tax deferred money is working for you.
That's phenomenal. That's great. I'm glad a lot of people, you're on the show, obviously, and I'm glad a lot of people that are listening to this, because I'm not sure if they understand that, or maybe their CPAs have not apprised them of that. So I hope that people reach out to you on here and definitely take advantage of your expertise and wherewithal to save money on taxes, obviously, and to benefit both parties, which would be great. Blake, moving on, you've been recognized nationally as a top, influencer. As far as the OZ zones for, you've touched on this for investors and developers, but maybe you touched on a lot of the pros, but what are the cons, I guess? I guess the con would be that you have to keep it for a 10-year horizon. Is that probably the biggest con that I understand it to be?
Yeah, when the program first came, I'm going to be honest with you, Michael. When the program came out, one of my managers, said, "Hey, Blake, I think we really need to look at this program." I read through it and I said, 10 years, our clients just don't have the patience for that. Private equity guys, have a much shorter, exit strategy. Venture capitalists, same thing. So I said, I just don't know that they're going to be patient enough for a 10-year. But what happens is, invariably people have this $20 million gain, $50 million gain, $100 million gain, and they start looking around for, I don't want to pay tax on this right now. And so
That's
it opens up. Yeah, it opens up the door to the conversation. And I'm going to be frank with you. Initially the conversation, same thing as I said, 10 years. I don't know. I don't know about these communities. And actually, a lot of these 8,700 census tracts are, a lot of them are not that bad. Where I sit, Salt Lake City, I'm in an opportunity zone in a six. We're in the newest 6-story high rise in Salt Lake,
That's
and
great.
it's a nice area. But people are still resistant to it. But so they'll often say, yeah, count me in because I like the deferral. I'll decide, if I'm going to invest long term. Let me see the lay of the land. And once they start looking at projects, sometimes it's something I'll bring to them. Oftentimes they'll call me on Monday and they'll go, hey, I was just with my brother-in-law and he's doing an Oz project, and so I would say 25 to 30% of these people that are kind of on the fence on whether they're really going to invest long term come to me because they heard through a friend of a friend, a live project, and they end up investing in it.
Okay.
So,
That's great.
yeah.
Blake, is there anything, so say, we have a ton of clients all over the country right now, and they may own properties in an opportunity zone and may not even know it.
Right.
And so is there any tax benefit? Say you've owned, say I bought an apartment building in Long Beach, say for instance, 5 years ago, and I come to you today, Blake, you know what? I don't know if my property's in this opportunity zone or not. Is there any benefit on that basis where that property is in the opportunity zone now at all?
So there's a couple of ways. If it's already been developed, it's tougher. But you could set up an Oz fund and just do a refresh on it.
So
Um,
there's a lot of like ADUs that are added. People are adding ADUs and different pieces of it, or a major renovation. Does that play into it at all?
yeah. So generally, to get compliant and have your Oz fund, get the 10-year tax-free treatment. If you buy, let's say that Long Beach apartment building you bought for 5 million, the land was worth 1.5 million, the building 3.5. You need to put an extra 3.5 million in rehabbing it in order to meet the substantial improvement test. You have 30
Yeah.
months to do that. It's very hard to do that on multifamily because you usually can't put enough money into it. It just doesn't make sense, right? But if you had a big enough plot of land that you could build a second tower on the property, that would work. Or you could just say, hey, the building itself, I'm going to leave outside the Oz structure, but I'm going to do an Oz fund and do improvements. And so now you've got a project that's 80% your legacy building and land, but the
Okay.
20% that you put in could be held by an Oz fund. And when you sell, 20% of your gain would be tax exempt, 80% would be
Wow.
still be taxable. The better example is you own a piece of land in the zone, but you haven't developed it and you bought that 5 years ago. That one, the land is a bad asset technically under the Oz testing rules, but as long as you can dilute the land value below 30% of the total project cost, you can make it compliant because they give, this is where the flexibility comes in. They allow you to have 30% non-Oz assets in an Oz fund without violating the rules. So as long as you can, when you go vertical on the project, as long as you can dilute the land below 30%, you can make that an Oz compliant project. So
Wow.
that's what we spend a lot of time on is, structuring, but there's some there's some, there's some landmines, but for the most part, everything in the regulations was very, very taxpayer friendly.
Wow. That's what made you get into the Oz funds? Like what made you, I mean, that's such a specialty, which is so smart. I always tell, younger people starting in the business or in real estate and finance, what I'm in or whatnot. They're always like, what is it? I'm like, well, get into something you really like and love and you won't be working many days of your life, number one. And number two, try and specialize in it and just work the hell out of it and beat out every competitor. So with you, obviously you've mastered this Oz fund space. And so
Yeah,
how did that all come
yeah.
about?
So early on, and I don't, I can't attribute who, which mentor, helped me on this, but somebody put the idea in my head. I don't think I came up with this myself, but I tell every new staff, that works for me, I tell them, I said, here's the key to success. You become a great generalist and know, a lot about, basic tax, for individuals, corps, S corps, partnerships, and some estate planning. You don't have to be an expert in everything, but really,
Just
really
no high
broad.
level.
Yeah, really broaden out and read about everything. Don't try and specialize early on in your career, but then at the 3-5 year mark, as you're moving towards manager, develop two specialties. And I always did this. When I was a staff person, I was the go-to person in KPMG's LA office for tax depreciation. So I did a lot of oil and gas and I did a lot of real estate. And so like I was the guy that knew all the different depreciation elections and things. And then that kind of morphed into equipment credits and hiring credits. I focused on that later on in my career. So I've kind of been a bit of a chameleon in developing, I kind of leave other stuff behind and then, go into other specialties. So when this program came out, since I was kind of regionally recognized as a tax credit expert, everybody thought this was a tax credit program. And so, I was getting emails from internal and externally saying, "Hey, tell me about the Oz credits." And I said, "Well, it's nothing to do with credits, but when you dig into it, it's way better than a credit because it's a tax
Yeah.
exemption." And I didn't buy into the program until I modeled out what a 10-year return on investment would look like with all that depreciation up front and then the tax-free treatment on the tail end. And then I was all in on it.
Right. Well, that's terrific. I mean, that's what obviously people that keep growing in their career, they're always evolving. And that's what I'm always telling people that, maybe coming up through me as an intern or whatnot, people I've seen, you got to keep pivoting. You got to be in front of the market. The real estate brokers on the investment side and capital side have had a tough run over the last 2.5 years, obviously tied to interest rates and a real sluggish market. But there's only two things you can control is activity level and skill set, right? So you constantly high activity levels and always hone in on your skills and the market will take care of itself. The market is what it is. You never can control it. So that's what I always say. And obviously you've done the same thing in your career and it's obviously paid off handsomely and, cheers to you on that. Like looking ahead, what tax trends or regulatory changes should businesses and investors be preparing for the next few years?
Well, I tell everybody, I mean, we're in the golden years of taxes, I think, and I'm a realist, and I'm telling everybody, it's like, look, we're at an all time low on the federal side. I think we're at an all time low of effective tax rates. Again, the tax code is very taxpayer friendly right now, but and even in the Oz world, under Oz 2.0, you're going to defer either 2026 or 2027 gain and then pay tax on that on 2032. You don't know, and I don't know what the tax rate's going to be in 2032. It's not a deferral of paying your tax; it's a deferral of reporting the income. So, we could very well have a Democratic administration at that point in time, and they could pop the rate. Now, under Oz 1.0, we know on December 31st, 2026, when you report the Oz 1.0 gain, we know what the tax rate's going to be. That's not going to change. But 2032, who knows? So, so anyway, that's my, my concern is, tax rate. And I think even a Republican administration next term or two terms out could raise taxes because the federal deficit's so high.
It's
I
huge.
mean,
What is it, 37 trillion right now? I mean, and
yeah.
it's, I mean, I don't know how this is going to go down. I mean, I don't know if they use tariffs to start paying it down or whatever they use, but I mean, I believe the deficit now on a annual debt service payment has exceeded our government and Medicare spending on an annual basis, which is something we've never seen in our lifetimes. And so it's so out of control with the government spending. I mean, I don't know how you come back from this.
No, I agree 100%. And so anyway, I think we have to, for the mid to long term, you have to anticipate that, you might be paying, you will very likely be paying more tax in the future rate wise than you are now.
Right.
And they're building in some inflation adjustments in the tax code. They probably need to do a little bit more of that. But again, we have a very taxpayer friendly tax code right now, but
Right.
it may not always be there.
Absolutely. And the big beautiful bill, does that weigh into this as well? Obviously, the Trump just passed. Is that a huge benefit? Really, we have a lot of real estate investors listening here. So how much does that really benefit them from a tax standpoint?
I mean, huge. We got bonus depreciation back. We've got use your cost segregation studies to maximize your depreciation. Um, there's and then they've made the Oz program permanent now. So that was a big question mark with everybody, and that was what we were lobbying for hardest was, let's not just have this a 10-year program. Now it again, we could get super majority 60 votes in the Senate and they could overturn this, but it's a little hard to overturn. So I think we are going to have some permanency to the Oz program. So
That's great.
it's a good time to be a real estate investor.
Oh yeah,
Trump's obviously pro real estate, and
right,
he's doing it in his tax code.
right. And I know that you and I have a mutual client right now too, and maybe even real estate that was not maybe down the middle of the fairway per se. I see that master's picture in your background. I have a master's picture in my office too with Amen Corner here. I love Augusta, but maybe the real estate investments that may be more of a going concern obviously can benefit greatly from this. I know like the C stores and the gas stations and more stuff that's a little bit funky, more of a going concern than just this true real estate play. Like we were talking about, like an apartment building, a shopping center, or an industrial warehouse, or an office building. Now, if you add a going concern onto it, that bonus depreciation is accelerated. And we've seen those assets really go up in value because of this new tax code. So I see people taking advantage of that in the market as we speak.
Right, and that's a good point. And I'm working on a $13 million convenience store gas station in Vegas right now. And yeah, the bonus depreciation on that's crazy. 35-40% of the cost of that project you can expense in year one,
Right.
and under the big beautiful bill. So
Yeah.
it's huge. And then this one doesn't happen to be an Oz project, but if it was, then you're just
That's a double home run, right?
yeah, it's
Yeah.
at least a triple.
Right.
Um, and,
That's
and
great.
one thing I want to interject too, I work with a couple of real estate firms, and what they do, they scour the country nationally for Oz projects that are in process, and they might be a Starbucks, a Chipotle, a Caliber Collision, and they're 60-70% complete with construction. As long as you go in and finish up the project, do the last 10-15% before they have a certificate of occupancy, before they've depreciated the property, you step into their shoes for the substantial improvement test, and you have a good Oz project. So a lot of our busy, high net worth clients that are, off doing their, their third or fourth business, they don't have time to do their own projects. So that's a nice way where they can go in, jump on a moving train, and
Right.
finish the project and still be under the Oz rules.
Yes, absolutely. Yep.
And you got a 15-year lease, signed with
Right.
a AAA, tenant.
Absolutely. And we're working on financing a project and, um, up in Sparks, Nevada right now, same type of deal. Client bought it all cash, and then the same thing in North Carolina as well. So same aspect of that, buying it before the C of O, which is a difficult sometimes to do on the financing aspect, but you can always finance it later and again take out that money tax free,
Right.
which is great. Um, Last point here, Blake. This is my favorite part of the show that I've always done for all the attendees of the show, and a lot of people have had a lot of highs in their career in life and lows. So if you could just touch on maybe a high you've had in life or career, and then a low, and then how you came back from that low. So it's just nice to share with the guests so that they can hear from someone as successful as yourself how that rebound happens. So because we all don't have, roses and unicorns all the time flying in life.
Yeah, and it's a great question, and it's it's everybody has ups and downs, and
Yes.
it's how first of all you got to be really resilient, and I would say I would start with you have to have a level of humility when you're working in a really complex area. I've seen it throughout my career. You go into a meeting and somebody on the other side is trying to make points with their client and things. And it's like, I don't care what the background of the person that I'm sitting across from, they could be a sole practitioner. I don't know what they know walking into a room. So I just never assume that I'm smarter. I never assume I'm the smartest person in the room. I always think that I'm not, and you're better off going in saying, being super humble and saying, I don't know anything. Let's just have a conversation. But I've just seen people that come in cocky, and they just get burned because there's so many exceptions to the exception in tax law that you can't get overconfident. So I'll tell, I guess, and I don't have one specific, but one, the thing that I always, kind of shake my head at is, and I was saying, everybody thinks being a CPA is really boring, and you're just sitting at a desk and crunching numbers all day. But through some of my community service and things like that, I mean, I've been in rooms with vice president of the U.S. a couple of times. I've been multiple governors, one-on-one meetings with very high level people, actors, actresses. It's just people you wouldn't ever expect to meet, especially with a somewhat boring, CPA kind of background. But it's fascinating, the people I've got to meet along the way.
That's great.
Um, the on the negative, the one that sticks with me, and it was when I was in private industry. It's old and cold enough that I can talk about it, but it was kind of the worst thing that ever happened to me. So I'm working at this publicly traded healthcare company. We ended up buying the second and fifth largest HMO in the country in the same month, and so we paid a big premium over their tax basis in those. And so under 338 code section, you can step up the asset values to fair market value and book a bunch of depreciation, which you can amortize over 15 years. And so it was 338 was relatively new at that point in time. We were working with one of the big four firms, big eight back then, and so they were doing a valuation for us so that we knew how much income inclusion we'd have and how much we could step up the assets. Well, the tax partner comes out from the big four firm and to review our tax provision, and he said, "Oh, by the way, can I see your 338 election?" And I said, "Well, we haven't filed it yet. We're filing it when we file the return." And it was kind of quirky. Usually most elections are due when filing the return. 338 had a weird architecture where they said, "Oh no, you need to make the election." I'm making this up, but 9.5 months after the acquisition date, and
Okay.
so it was just kind of a weird filing deadline. So anyway, we had to go to, we filed a private letter ruling to request relief. They turned us down, so we hired a big, powerful law firm in Washington D.C. and went and met with the IRS. And initially they turned us down too. And luckily, the attorney that we had hired wrote the treatise on C corps and was involved in numerous legislative matters, and just happened to be she wasn't a Supreme Court justice at the time, but Ruth Bader Ginsburg's husband.
Ah,
Marty Ginsburg, and this guy was just brilliant, and he funniest guy you'll ever meet too. But he ended up just like bullying the IRS and said, if you don't give us this ruling, we're going to work it against you on these other cases that we're working on. And they huddled, and the next day they came back and granted our relief.
whew.
But so anyway, from a terrible situation, we ended up getting a good result, and I get to meet Marty Ginsburg, and we were working late at night in the office and having dinner in the office and stuff, and his wife's picture was back there, and he goes, "She's the smart one," and I'm going, "Oh, what a humble guy," and he goes, she was like a circuit court judge at the time. And then, 20 years later, she's a Supreme Court justice. But
Wow, that's a
super,
great story.
super nice guy. Yeah, actually wrote her a letter when he passed away. Just telling her what a charming guy he was.
Oh, that's great, Blake. That's pretty impressive. Well, obviously a phenomenal career, and you obviously have helped a ton of clients, and we're actively working together on business. So we're super thankful, and I'm very thankful for you taking the time and going through this. And I know our listeners are going to benefit greatly, and I think you'll probably be getting some phone calls about some new business as well after this. So I can't thank you enough for your time today, Blake. Thank you, and
Thank
really
you.
appreciate it.
This was
And
a lot of
everyone,
fun.
thank you, Blake. Well, that's a wrap for another episode of Show Me the Money. Thank you, everyone. I hope you've enjoyed, and stay tuned for the next episode coming up very soon. Have a great day. Thank you.